Saturday, July 10th, and I'm going to go over some charts for you. And I think that the market is putting in another short-term top, and it's going to be a major top in this long-term bear market that recently resumed in the end of April. We're going to look at some charts. We're going to look at the SPY hourly first. All right. Okay. And let's see here. All right, the hourly chart. As you can see here, we closed at 107.96, which is an interesting close because 2 weeks ago the high of the week was 108.23, so we didn't take out that high. We do have an interesting development here. We have the 18 period is about to cross the 100-day. Probably will get a cross on that, and you know, it could be. I think it may be like a fake out. I'm not sure. This market could still have a little more upside. The volume was really pathetic Friday. There was a big gain Wednesday. You know, big 300, almost 300 point gain in the Dow. Thursday we grinded up a little higher in lighter volume, 100 point up day in the Dow. And Friday, very light volume, about 50% of Wednesday's volume, and we closed up 80 cents on the SPY, or roughly 8 S&P points. As you see here, we are, you know, on the stochastic, we've been overbought. We remained embedded, and you know, the stochastic reading is 96 and 92, which is extremely overbought. So even though it is embedded, and you have to, you know, respect that somewhat, I do think that the market is likely to pull back here. My first target would probably be, at the very least, even if you're bearish, I think we should pull back to this 104.30 area, which was the previous S&P head and shoulders neckline breakdown, which you know, as we see here, earlier in the week we went up and tested it, sold off sharply, pulled back, and then we rallied above that. And once we rallied above that, it caused a lot of short covering up until 107. So you actually had like an inverse head and shoulders pattern here, which measured to like 107 or 108. So we hit the target. The histogram has been ticking down for a while, and you know, we are very overbought. You know, could be putting in a potentially negative divergence on the money flow here. RSI is 74.59. It's actually a new high for quite a while. So this chart is you know, this chart is saying that, you know, this, you know, whenever you have the RSI up that high, it could still run a little more. But then I refer to, this is the reason why I refer to you know, other charts in other time frames. Hold on a second here. Got logged out of this account here. So yeah, the next chart I'm going to look at is the S&P, well, the SPY 15-minute chart. And what this is saying is the same thing with the 5-minute chart is also saying. As you see here, we have an ascending wedge here, rising wedge, which is bearish, going from 106 to 106 low to, you know, basically it was Thursday's action all the way to Friday's close. We hit the top part of the wedge, so there's a good chance that we and after hours I noticed that it was trading down to 107.64 or something like that, so it could possibly you know, open up below this and just keep going down. We've had negative, this happens a lot. You have the real high RSI reading, and then you have two or lower highs on the RSI. In this case you might actually have 3, and you have higher highs in price action but lower highs in the RSI, and then you have lower highs in the MACD also, and you have lower highs in the stochastic reading too. So the market is getting, as it's going higher, it's getting weaker. That's why it's very good to follow technical analysis. So if you see here, you notice price is going higher, and a lot of people are like, why does the market keep going up? It's, you know, low volume. Yeah, well, this is how, you know, you get sucked in on the long side. You know, you think it's breaking out, but there's no volume, and that's why when there's no volume, there's really no validity. That's how the phrase goes. And it's basically it's coiling up and it's setting up for an explosive downside move once the volume comes back. You know, you have the lower highs in the MACD, which is reflecting weakness in in buying pressure on this market. So not a lot of people, not a lot of reasons to get excited for the very near term. If you're bullish, I would look for, you haven't really had a retest of the 104.50 area to confirm that the break of the S&P 500 neckline on the daily chart, which I've been talking about for a while. I'll show you that on the daily chart here. Well, here on the daily chart. This chart is the SPX. It does not show the head and shoulders breakdown here, but you do see the action. You're approaching the downtrend line and the 45-day at approximately 10 in the 1080s on the downtrend line, and 45 is 1090.67. So they're both roughly in the same location. You have the RSI did not make a lower low on this last drop, but that does not mean that it's necessarily over this downtrend. It could be just a fake out. As you see here, the volume bars are decreasing as we go higher. You had a bigger volume on the big up day, but that wasn't huge volume by any means, considering the up move. And the MACD, you have a higher low right now, but you don't have a higher high. And I don't think you're going to make one. I think you're going to put in a lower high here. I think you're just in a consolidation phase. I think we might touch that line again, and then sell off and head to new lows. And eventually, the head and shoulders target will play out of 875. It's not as simple as sometimes the neckline breaks and then you go straight down. Sometimes things like this happen. It's not perfect. It's it's a good long-term thing to follow the neckline. I think you still got that's still in play. The stochastic is up to about 48 and 35 on the red. It looks like you're putting in a potential lower high here on the CMF money flow compared to the other rally, which would be bearish. So if you're bearish, you want to see this MACD really. You want to see like this reverse really quickly. Another chart I'm going to look at is the SPY weekly chart, and as you see, it's inside of last week's candle. The MACD is below the zero line. You have a negative crossover still. You do have a stochastic reading in the 20s on both, but the stochastic is still pointing down. So and I think that there's still negative pressure in the market. I think this market's going to bottom around the 85 area, 85 to 90 area on the SPY. As you see, I'm pointing here with the pointer. And the volume, as you see, was very weak compared to the last 2 weeks' volume. So it looks like it was a nice dead cat bounce, as they call it. I would not, if anything, if I'm going to be getting long again, I'm going to be waiting for that 104.30 area. It could be a bounce off there. You could just wind up ripping right through it, and you could be at new lows by the end of this week. Would not surprise me at all. So because basically the weekly candle saying too, we were inside last week's action. So this week was a low volume inside candle, even though it was a 5.64% up week. You still had light volume, so you need to respect the bear camp here. You should have a pullback. Will that pullback bring in buyers, or will that pullback just crash because there's light volume on this rally, and we're going to break new lows this week and continue the vicious downtrend that's been going on. Economic data does not look too solid. Economic activity, me engaging on my own, talking to business owners and then people in general, I don't think that things are really getting better. I think there's a lot of debt problems, a lot of problems with real estate, a lot of problems with people not paying. Well, a lot of this positive retail numbers I think had to do with people not paying their mortgage, not so much people thriving and making more money and more jobs and stuff like that. So you have to be very careful on the long side. So this is going to be part one. I'm going to make another video definitely going over the VIX and the US dollar.